The dislocations we've had since really COVID and then the Russian invasion of Ukraine have probably caused the biggest dispersion in stock market and country performance since the 1990s and the crisis we had then. We are considering emerging markets more and more as not an asset class, but a series of individual opportunities, where the top-down key is to be out of the opportunities where you think there is an existential risk to markets or countries, and focused on the opportunities where we think there are strong prospects for growth, which are largely coming about as a result of strong reform processes. To give a couple of examples, Egypt was the most negatively impacted country by both COVID and by the Russian invasion of Ukraine of probably any country in the world. We don't think you'll make any money investing in any stock in Egypt. If you look at the strongest reform processes in the region, they're happening in regions like the Middle East, where you're having the biggest social and cultural change that I've seen since the fall of the Berlin Wall in 1989. The major growth opportunities we feel are in markets that are reforming strongly. We've always found that political, economic and stock market reform create economic growth, and the best place to look for countries and companies that can compound their earnings and their economic growth over many years are countries that are reforming. So, for example, the market-based reforms in Vietnam that started 20 years after North Asia are going down exactly the same political and economic path and producing the same results. 7 to 8% economic growth a year is a very good hunting ground for companies that can compound their earnings. The Middle East, again, is reforming at a rate that we haven't seen in any emerging market region for 30 years. And even countries that are off most international investors' radar screens, like Greece, have massively restructured their debt, their banks and their whole economy in the last 4 years, and now provide a very strong growth opportunity and a very interesting place to look for strongly growing companies. Valuations versus developed markets for emerging markets are probably as cheap as they've ever been, aside from some of the early 90s emerging market crisis. This discount is partly explained by the underperformance of emerging markets generally over the last 10 years, but also I think a reluctance, because of some of the geopolitical aspects of what's going on at the moment with regard to China, Taiwan, Russia, South Africa, Turkey, of investors actually committing to the asset class. Valuations in the smaller emerging markets outside the top 6 are currently in the range of 10 to 11 times 1 year forward earnings, again, as low as we've ever seen them. And I think picking out those countries that are going to continue to do well, are benefiting from what's happening at the moment or benefiting from reforms, trading at very cheap valuations, are great alpha generating opportunities going forward.